Welcome to the Explainer. Every massive company out there has a kind of secret weapon, an internal team of detectives. Their entire job is to find problems before they completely blow up. They're basically the company's first line of defense against total chaos. So, today, we're doing a full breakdown of the world of internal audit. So let's start with the big question. Just think about it for a second. How do these massive, sprawling companies with thousands of people, offices all over the globe, how do they stop themselves from just collapsing from the inside out? I mean, one bad process, one person making a mistake could literally cost millions. The answer lies in this function you don't hear about much, but believe me, it is absolutely critical. Internal audit. All right, so to kick things off, let's figure out what this internal detective agency really is. When you hear the word audit, what do you picture? Probably some strict, by-the-book inspector, right? Someone who's just there to find what you did wrong. But is that the whole picture? Or are they maybe more like consultants, there to actually help? Let's get our definition straight. Okay, this official definition is actually super important for understanding what they do. Let's pull it apart. Independent and objective, that just means they have to give an unbiased opinion, totally separate from the departments they're looking at. Assurance is them checking if all the company's rules and systems are actually working. But then there's the consulting part, where they give advice on how to get better. And honestly, the most important phrase here is the last one, to add value and improve operations. See? It's not just about catching mistakes, it's about making the whole company run smoother. So why do you even need a whole department for this? Well, imagine you own a tiny little coffee shop. You see every single dollar that comes in, you know all your employees. In a way, you're the internal audit. But what happens when that little shop grows into a giant global chain? You can't be everywhere at once. Management has to trust other people, and with that trust comes risk. Suddenly, processes get way more complicated, and things can start breaking down without anyone even noticing. So internal audit becomes management's eyes and ears on the ground. It's their way of staying in control when they just can't see all the moving parts anymore. Now, this is really important because it's where a lot of people get mixed up. You've definitely heard of auditors before, right? The folks who come in at the end of the year and sign off on the big financial reports. Well, those are external auditors. So how are they any different from the internal team we're talking about? It's a huge distinction, so let's draw a really clear line between them. At its heart, the difference is dead simple. It all comes down to who they work for. Internal audit, they work for the company's management. They're there to help the bosses run the business better every single day. External audit, on the other hand, works for the shareholders, the owners of the company. Their job is to tell those owners whether the financial numbers are legit. And that one fundamental difference in who they answer to, it changes absolutely everything about their job. This table really breaks it all down. Just look at the objective. External auditors, they just give an opinion. It's like a thumbs up or a thumbs down on the financial statements. But internal audit's objective is to actively improve how things are run. And the reports are totally different. The external one is public for anyone to see. The internal report, that's a private memo for management. And check out the scope. External audit is laser focused on the financials, but internal audit scope can be massive, covering pretty much anything management wants them to look into. So that wide scope is what leads us to the really interesting stuff. What kind of cases do these internal detectives actually work on? Well, it's time to open up the case files and see what their day-to-day assignments really look like. This gives you a taste of just how varied their work is. I mean, it goes way beyond just checking the numbers. They're diving into fraud investigations, making sure the company is following the law, checking up on complex IT systems, and just making sure things are running efficiently. It's a huge toolkit, so let's break down a couple of the most important tools they have. First up is what's called a value for money audit. A good way to remember it is the 3 E's. First, there's economy. Are we getting good quality stuff for the lowest possible price? Are we not overpaying? Then there's efficiency. Are we getting the most possible output from the things we bought? And finally, there's effectiveness. And this one is the real kicker. Are we actually achieving what we set out to do? Because, it's possible to do something really cheaply and efficiently, but if it's the wrong thing, well, it's not very effective, is it? Let's make this real with the hospital example. For economy, an auditor would check if the hospital is getting the best price on its medical supplies. For efficiency, they might measure how many patients are being treated with the current number of doctors and beds. But effectiveness, that's the ultimate goal. Are the patients actually getting better? A hospital could be super cheap and efficient, but if its patient recovery rates are awful, then it's failing the most important test. And it would definitely fail a value for money audit. Okay, here's another classic case file, the operational audit.
Just picture a sales process where an order comes in and someone has to manually type it into the sales system. Then they send a copy to the warehouse where someone else manually types the exact same information into the shipping system. And then another copy goes to finance, where it gets typed in a third time for the invoice. It's just so slow, so inefficient, and you can just imagine all the typos and errors.
So the internal auditor spots this mess and makes a simple but really powerful recommendation. What if we just had one system that talks to everything else? The sales team enters the order just once, and that data automatically shoots over to the warehouse and then over to finance. This is a perfect example of adding value. They didn't just find a problem and point a finger. They proposed a solution that makes everything faster and more accurate, saving the company a ton of time and money. So we've seen what they do and how they can be incredibly helpful. But just having an internal audit team isn't enough. What are the qualities that make them really effective? And maybe more importantly, what are the built-in challenges they face? The things that could actually undermine their work from the inside. For an internal audit team to really work, it needs a few key things. First, it has to be sufficiently resourced. You can't run a detective agency on a shoestring budget. It's got to be truly independent, which is why it's so important for the head auditor to report to the board's audit committee, not to a manager they might have to audit someday. They need full access to everything, no locked doors. And finally, and this is a big one, they can't have any day-to-day operational duties themselves. Why? Well, because you can't be objective when you're grading your own homework. But here's the fundamental problem, the internal struggle. Because they're employees of the company, being truly objective is incredibly hard. I mean, put yourself in their shoes. Would you be excited to write a report about a huge mistake you found in your own boss's department? What about auditing the work of a colleague you've been friends with for 10 years? This is what's called a familiarity threat, where your personal relationships can cloud your professional judgment. Being an insider gives them amazing knowledge, but it also creates this unavoidable potential for bias. So, given how hard it is to be an objective insider, how does a company solve this problem? Well, here's the twist. A lot of companies are now looking outside for a solution. They're actually hiring external firms to come in and do the job of an internal team. This is the world of outsourced internal audit. And you can see why this is so tempting, right? An outside firm is instantly more independent and objective. They don't have those tricky office relationships or fears about their job security. The company also gets instant access to highly specialist skills, like an expert in cybersecurity, that would be way too expensive to hire full-time. It can even be more cost-effective since you only pay for what you need. And honestly, it frees up management from the headache of building their own team from scratch. But of course, it's not a perfect solution. Outsiders just don't have that deep, gut-level knowledge of a company's culture. They can be really expensive, and they might not be available at a moment's notice like an in-house team would be. But there's a huge ethical trap here. What happens if the company's external auditor, the one who signs off on the final financials, is also the firm they hire to do the internal audit work? That's a massive conflict of interest. It's literally like a student grading their own homework. That's a serious problem, because they could end up auditing and giving a thumbs up to their own advice. So, we end up right back where we started with this really fundamental question. What makes a better watchdog for a company? Is it the loyal insider, the person who knows all the company's secrets but might be a little too close to see the whole picture, or maybe even too scared to speak up? Or is it the impartial outsider who has that clear, unbiased view but just lacks that deep, intuitive knowledge of how the company really ticks? As we've seen, there are serious pros and cons to both, and finding that perfect balance is a challenge every single major company has to wrestle with.